All right, join us now for a one-on-one interview here on public.com. We've got Cem Karsan. He's the founder and CIO of Volatility to discuss current market behaviors in wake, of course, of ongoing higher inflation. Cem, I really appreciate your perspective here and your time. The S&P and NASDAQ both dropped around 1% in yesterday's session, of course. After that closely followed CPI print, it came in hotter than expected. We did see prices rise 0.4 for the months of March and 3.5% or so annually. What are your main takeaways from the CPI report that seemingly not a lot of people were expecting?
Yeah, to be clear, if you've been paying attention, inflation is sticky, right? It's not transitory, despite what the Fed will try and tell you. Why does the Fed keep calling it transitory? This is now the third time we've fallen for this, right? Is because it is in their best interest, not because they actually think it's transitory. They know better, but there's a self-fulfilling prophecy to inflation. If people believe inflation is here to stay, it is self-perpetuating, right? People go and pull forward demand. So that has been the truth from the very beginning. So I find it comical that all the CNBCs of the world go out and try and perpetuate this narrative, right? When the reality is we know that's not true. How do we know that's not true? Because not just the core components, but the key components of rent, of also housing broadly, food now, and other commodities like energy are also now going higher too, and all of them are tied to the same realities, right? They're all tied to the same realities, which are deglobalization, increasing labor costs, the increasing cost of inputs to production, and those are a function of populism. Those are things that are not a function of economic cycle. That's not because growth is strong or not strong. When you start reducing the $250,000 a year jobs, but you start adding $50,000 a year jobs, that will increase, actually, despite it being minimal growth, that'll increase inflation because the money is being spent, the velocity of that money is one, as opposed to what's been happening in the past. So that's what we've been seeing now, really for the last 4 years, secularly. That's not going away. It's something we've seen in other cycles in the past. And so now we have a not just two-dimensional form of inflation. We have secular inflation, and then we're trying to battle it with this kind of cyclical component. So not a surprise here. We're seeing inflation rekindling right as the Fed says, okay, we're no longer going to cyclically try to control the secular inflation. We're willing to cut. And that was the green light in December, right? That markets got, that the economy got, that we're no longer going to have to worry about headwinds from the Federal Reserve. And of course,
sure,
that's just going to lead to a second round.
So, Cem, whether it's CPI, PPI, or PCE, which comes out at the end of every month, it seems as if whenever we get these recent inflation readings, we sort of then settle on the fact to say, okay, the Fed is not going to cut as soon as we thought. We're going to kind of kick this timeline down the road. And we did see that, at least according to the CME Group FedWatch tool yesterday after the CPI print. What are your thoughts with regards to the central bank's rate cut plans? We know what Chairman Powell has said publicly to members of Congress and in other settings, but what is your take on how this will approach? And keeping in mind, we'll soon be right up to the November election. And we know historically the central bank wants to avoid kind of mixing politics with monetary policy.
Yeah, we're entering a stagflationary period. That is a function of higher inflation and structural versus cyclically kind of increasing interest rates, doing Q2, doing things to slow down the economy. So the economy is slowing, but inflation is still resilient, right? In that situation, the Fed has two mandates. They have to choose which one they are willing to favor. And what they've chosen, which has been very clear, and they've been public about this, is growth. We can argue whether that's right or wrong, that they should be more, that he shouldn't be Burns, that Powell should be out kind of trying to be Volcker. But he's basically said, look, I'm willing to be Burns. I'm willing to go out there and stimulate in the face of some sticky inflation for the sake of growth. Now, that's loud and clear. And the markets heard that loud and clear. That's why the markets continue to be resilient. Yes, we'll get a dip, marginal dip that we're seeing in that environment. But assets have been very, very hot in the face of that. So my view is that the Fed has told you what they're going to do, and the numbers don't really matter apparently, because this is the fourth such number, right, that we've gotten now, and they've all been hot. And yes, we've backed off from 4 cuts down to 1.5 expectations, but we're still talking about cuts, right? We're still talking about a Fed that is going to be accommodative in the face of all these things. So all it would take was that one bad number for us to have 2-3 cuts back on the table, right? And my view is that the Fed is here to make sure to underpin, to sell puts essentially to the market and to underpin growth. Why have they all of a sudden made this about face? Well, I think it's a fairly political reality. The Fed has always been political. People try and argue that it's completely off on its own, but it's not. It's doing the bidding of what the policymakers in the United States believe is best for the United States. And in this election year, that is support growth. So my belief is that they will continue to do that. Eventually, I think this will go too far in terms of markets' expectations of the Fed not stimulating. I think the linearity that we're drawing behind hot CPI and the Fed not stimulating is incorrect.
Do you see a scenario where the Fed actually raises rates before they cut?
Absolutely not.
Absolutely not. Why not?
Not this year. Not to be clear, I wouldn't say there is a definite chance that they do nothing this year in the face of very strong growth numbers and sticky inflation that continues to show up hot. I think there's a very decent chance they do nothing. I do not think they will raise this year. I think that would be entirely counter to what everything they've told us so far this year.
What are your expectations for volatility as we head a little closer to the next Fed meeting, which is set to begin on April 30th? And any takes you have on the volatility we saw surrounding CPI's release yesterday?
Yeah, honestly, the volatility we saw was very muted. When you look at a fixed strike basis, which you look at the actual underlying implied volatilities of the volatility surface, not just looking at the VIX, right? The VIX is a measure of floating vol. You slide down that curve and you look at actually the fixed strike vol. Vol came down yesterday. It came down a significant amount. And it was a little up again this morning. And then what happened? Right down again this morning. That's more for structural reasons because vol is very well supplied through structured products as well as structurally through it's very easy for market makers and dealers to continue to be long implied volatility. And when they are, then there's constant vol supply. So there's this kind of macro versus flows reality that's happening right now where there's natural support, structural support in the market due to flows and structural supply of vol, particularly here going into OPEX in the next week and a half. So that is going to make it hard for markets to sell off in a meaningful way. And especially with, yes, we have inflation. Yes, that may mean the Fed is slightly less stimulative than they were talking about. They are still very accommodative into what is a relatively resilient economy. And that's very good for markets in the current backdrop.
Absolutely. I got time for about one more. How are you trading the overall market story that we've seen so far here in 2024? And for some of our entry-level options traders, can you break down some simple strategies related to that market story? Options is something we're focused on a lot, and we know there's a lot of interest out there as well.
Yeah, implied volatility is well supplied, but it is cheap. So the odds of it performing are low into a drop or into some volatile outcome. However, the way the volatility surface works, the calls are the cheaper implied volatility. And if the market, which I believe it will continue to do, continues to rally, that this is a digestion, a viable dip, and ultimately there's a leg higher, implied volatility is simply too low as you rally, right? There's a natural slide to a lower implied vol. So my view is that you should be looking for ways to own calls, longer dated, meaning out later in the year, 3 months, 6 months, 9 months out, and be monetizing other volatility against that's shorter dated. You can do that with both short dated calls as well as short dated puts. It is a much more forgiving way to be long this market. And then meanwhile, you can collect decay while still being long vega and still be long implied volatility, which honestly is quite cheap as you look forward into the year. So I think we have a period here in particular, like several months, where the upside volatility, which is where the majority of the volatility in this market has been coming, is going to be a bit more muted because of the backdrop of higher inflation and kind of some of the things we've been talking about. But I do still think the backdrop for a very kind of a continued rally is still very much there. And because implied volatility is very cheap in the longer dated calls, that is the best way to position on a risk adjusted basis.
All right, right on. Thank you for the context and perspective. We'll have to leave it there. My special thanks there to Cem Karsan, the founder and CIO of Kai Volatility. Cem, thanks for being here.
Always my pleasure. Thanks for having me.